Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
We have some fascinating topics lined up for you. We'll be diving into why foreign investors are still keen on Indian debt even as they move out of equities. Plus, we'll discuss Seagull India's recent investment of 109.19 crore rupees in Welgon Power, highlighting some exciting developments in the energy sector. And finally, we'll take a closer look at India Inc.'s revenue growth hitting a 2-year high in Q1, according to CRISIL's latest report. Stay tuned.
Foreign portfolio investors pulled nearly 280,000 crore rupees from Indian equities in the first half of 2026, yet invested over 35,000 crore rupees through the fully accessible route in Indian debt. What drives this contrasting flow?
Despite global uncertainty, India's debt market benefits from strong economic growth, stable inflation, and regulatory reforms like index inclusion and wider access. Investors value macroeconomic stability and market infrastructure more than just yield, especially as developed markets offer competitive returns. The investment thesis has shifted from chasing high yields to seeking risk-adjusted returns with reliable policy and market predictability. That's why June saw the strongest fully accessible route inflows in over 15 months. It signals sustained confidence in India's fixed income story despite equity volatility, with foreign investors viewing Indian government securities as stable exposure to a growing economy, not just high-yield instruments.
Here's another significant update. Seagull India has approved a capital investment of 109.19 crore rupees in Welgaon Power Transmission, backing a 450 crore rupee project for a 400 over 220 kilovolt gas-insulated substation in Maharashtra. This equity is key for securing term loans and executing the asset.
This move significantly diversifies CDCL's portfolio beyond road projects, providing stable annuity income of 58.5 crore rupees annually over 35 years, reducing reliance on volatile EPC cycles and enhancing long-term cash flow visibility. The investment marks CDCL's shift to asset-heavy power transmission under the tariff-based competitive bidding framework, aligned with their robust Q4 fiscal year 2026 showing a 71% net profit rise, signaling a strategic evolution.
Market analysts expect this to positively re-rate Seagull's stock due to the long-term revenue certainty, despite a temporary rise in debt-to-equity ratio, while also boosting sectors linked to power auxiliary and construction services as the project advances.
Moving to our next story. India Inc.'s revenue growth hit 11 to 11.5% year-on-year in Q1 2026, the highest in 2 years, driven mainly by pricing gains rather than volume increases. Aluminium and automobiles led despite higher input costs and geopolitical tensions.
That shift to pricing power shows strong domestic demand, supporting sectors like telecom and fast-moving consumer goods. However, export industries face supply chain challenges, limiting their growth despite healthy domestic demand. Despite revenue growth, EBITDA margins contracted by 75 to 100 basis points due to rising costs in fuel, freight, and raw materials, with airlines and tire manufacturers seeing the sharpest margin declines, highlighting pressure on profitability.
Going forward, sustaining earnings depends on companies' ability to pass on cost without hurting demand, plus easing global energy prices and monsoon progress, which will influence rural demand and consumption sectors.
Let's look at another key development. Bloomberg has launched its first fully electronic trading workflow for Indian government bonds, allowing foreign portfolio investors to trade directly via the Bloomberg terminal integrated with the negotiated dealing system, order matching managed by ClearCorp.
This integration significantly enhances market efficiency by reducing manual errors and improving liquidity, making Indian government bonds more accessible and transparent for global investors. It also aligns with Bloomberg's strategy, as India's fully accessible route bonds will be included in the Bloomberg Emerging Market Local Currency Government Index in 2025. Connecting Bloomberg's global liquidity with India's system marks a key step in linking India's debt market to international financial networks, boosting investor confidence and participation.
Let's move on to our next article. Deutsche Bank's private banking team is eyeing bonds in India and Indonesia, but only if oil prices stay between 65 to 70 Indian rupees per barrel for about 2 months. Lower energy costs could ease inflation and improve bond yields there.
That makes sense. Both countries are sensitive to energy prices. With Brent crude recently above 80 Indian rupees due to geopolitical risks, investor caution is high, pushing global bond yields up and limiting appetite for emerging market bonds. Deutsche Bank remains cautious. Their chief investment officer hasn't taken big positions in Indonesian bonds since October. They're waiting for a stable period of low oil prices, possibly 3 to 6 months, to expect trade balance improvements. So sustained low oil prices are key to boosting confidence. If that happens, Indian and Indonesian bonds could become more attractive, but only once geopolitical tensions ease and energy costs stay down consistently.
Moving to our next story. PNB Housing Finance has issued 50,000 non-convertible debentures amounting to 500 crore rupees with a coupon rate of 7.83% per annum, maturing in just over 3 years on August 7, 2029.
This strong institutional demand reflects confidence in their AA+ rating and stable outlook. It also aligns with their focus on affordable housing loans, strengthening liquidity to support credit growth in the current fiscal year. Their recent capital boost of 2,500 crore rupees through a rights issue improved asset quality and credit profile, enabling this fixed-cost borrowing at a competitive coupon rate. Market-wise, this issuance sets a benchmark for mid to large housing finance companies, showing robust liquidity access despite interest rate risks and sector challenges, positioning PNB Housing for steady expansion.
Let's look at another key development. CARE Ratings upgraded International Conveyors Limited's long-term bank facilities to BBB with stable outlook and short-term facilities to A3+, following a robust 44% revenue growth to 203.65 crore rupees in fiscal year 2026.
This upgrade reflects improved financial stability, especially with the profit before interest, depreciation, and amortization margin rising to 20.01% and an interest coverage ratio improving to 4.58 times, enhancing the company's debt servicing capacity. However, profit after tax declined to 68.06 crore rupees from 76.25 crore rupees due to reliance on non-operating income, while gearing improved to 0.18 times, indicating better debt management. The company's order book of 76.01 crore rupees, mostly from exports and diversification into wind power and steel cord belts, provides some risk buffer, but exposure to group entities at 149.92 crore rupees poses concentration risk investors must watch.
Now, let's discuss another important development. Unlisted bonds now form 40% of India's corporate bond issuances as of May 2026, up from 31% in May 2025. Companies like Bajaj Finance and Vedanta prefer negotiated deals with select investors to bypass lengthy compliance and disclosure.
This shift allows faster fundraising while maintaining credit quality. The market sees direct issuer-investor negotiations, especially for smaller issuances, reflecting increased investor trust despite fewer public disclosures. Importantly, the rise in unlisted and unrated bonds does not mean lower credit standards. Large borrowers continue issuing these to balance regulatory ease with investor confidence, sustaining strong momentum into July. So we're witnessing a strategic evolution in corporate debt. Firms prioritize efficiency and flexibility without compromising on the creditworthiness expected by institutional investors.
Let's look at another key development. HDB Financial Services allotted 30,000 non-convertible debentures worth 3,000 crore rupees via private placement to institutional investors, boosting their capital ahead of a planned IPO in late 2025 or early 2026.
This capital raise strengthens their Tier 2 capital and improves liquidity, aligning with regulatory demands under the Reserve Bank of India's scale-based regulation, which requires higher capital for large non-banking financial companies. Listing these debentures on the Bombay Stock Exchange wholesale debt market also enhances secondary market liquidity and supports sustained loan growth in retail and micro, small, and medium enterprises segments. Institutional confidence and backing from their parent private sector bank improve their credit profile, but risks like interest rate hikes and regulatory changes remain relevant for investors.
Moving to our next story. State Bank of India is selling a 1.42% stake in SBI Funds Management through a pre-IPO placement worth 1,655 crore rupees. Shares are priced at 574 rupees, the top of the IPO band.
This pre-IPO sale shows strong institutional interest ahead of SBI Funds Management's planned $1.22 billion IPO opening on July 14th, signaling confidence in the asset management firm's valuation. SBI won't issue new shares in the IPO, instead selling up to 128.3 million shares. The European partner, Amundi India Holding, will sell 75.4 million shares, together divesting about 10% of paid-up equity. This strategic divestment unlocks value for both promoters while they maintain significant stakes, setting a clear path for market debut scheduled on July 21st at a targeted market cap of up to 1.17 trillion rupees.
Moving to our next story, DBS Bank India posted a record net profit of 1,020 crore rupees in the financial year ending March 2026, a 49% jump. Advances grew 15% and gross non-performing assets fell from 2.78% to 1.34%.
That's strong asset quality improvement. Plus, with a capital adequacy ratio of 19.7% supported by a 1,600 crore rupee capital infusion, the bank's balance sheet looks robust for future growth. Their credit ratings remain solid too. CRISIL reaffirmed the bank's AAA stable rating for corporate credit and A1 plus for certificate of deposits, reflecting strong market confidence. Coupled with awards like Best Digital Bank for Small and Medium Enterprises and recognition as Safest Bank in Asia, DBS India's strategic growth and sustainability initiatives reinforce their leadership.
Here's another significant update. Save Microfinance raised debt funding of 40 crore rupees with 25 crore rupees from Indian Overseas Bank and 15 crore rupees from Northern Arc Capital. This boost will expand lending to women entrepreneurs and rural households.
This funding signals strong confidence in Sevi Microfinance's governance and portfolio quality. It also aligns with market trends towards supporting financial inclusion for underserved communities. They're also eyeing further borrowing under the Credit Guarantee Scheme for Microfinance Institutions 2.0, aiming to diversify funding and grow their loan portfolio responsibly. Leveraging this scheme will help Sevi Microfinance accelerate expansion and deepen credit access, driving inclusive growth and economic empowerment in rural India.